Okay, today's lecture is going to be on preparing flexible budget performance reports. And I'd like to share my screen with you at this point. And what you're looking at this point is a document that I have loaded up onto Sakai. If you go to Sakai, you go to resources, you'll find flexible budget performance reports. These are my lecture notes as well as the problems that we'll be looking at for this material. What are performance reports? A performance report is a comparison between how we thought we were going to perform and how we actually performed. So we just finished a chapter on preparing budgets. And remember what a budget is. A budget is a plan. A budget is a document that estimates how the company will perform at a certain level of production. The very first question that a company has to ask when preparing a budget is, how many units of our product do you think we're going to sell? And if you recall back to the Hays Company master budget problem in the previous chapter, that was indeed the very first question that they had to answer. How many units did they expect to sell during the year? Once they had that answer, they could go about preparing a production budget, direct materials budget, direct labor budget, manufacturing overhead budget, selling administrative budget, for the whole purpose of what? Figuring out what a projected income statement would look like. What are the estimated revenues and what are the estimated expenses? Ultimately answering the question, what would net income be? So that was the process to prepare a budget. What we're going to do now is prepare a performance report. And a performance report is a comparison, once again, a comparison between the plan, the budget, and actual results. How did we do in comparison to how we thought we were going to do? So what we had previously prepared in chapter 22, preparing budgets, was a static budget, the planning budget. And I have some definitions here. A static budget. A static budget is the budget or the plan as originally developed using the original number of units expected to be sold. It's prepared in advance. It is prepared before they embark upon the month or the quarter. Let's assume, for example, that we are preparing a budget for the month of, let's call it April of 2020. We're going to prepare that budget probably the end of March of 2020, based upon how we think we're going to perform in the month of April. We prepare that budget, we put it aside. That is a static budget. That is a planning budget. That is a budget is prepared in advance before the month of April begins. It's a good budget. It's a plan based upon how we think we're going to perform, based upon an estimated level of activity, the number of units we sell. What we're going to talk about in this lecture is flexible budgets. What is a flexible budget? And I've kind of typed it out for you here. The book talks about it a little bit more, but this is the definition I like. The flexible budget is it's still a budget. It's a plan that has been adjusted using the same formulas and budget assumptions, except with the actual, not the expected number of units sold. So again, it's still a budget where we use cost formulas, quantity and price assumptions and calculations to come up with a budget, except the number of units that we sell is going to be based on the actual number of units, not the estimated. Remember, the static budget uses the estimated number of units they think they're going to sell. The flexible budget uses the actual number of units sold. The budget has been adjusted or flexed to the actual level of activity, also known as the flexible budget. This budget report answers the question, how should the company have performed at the actual level of activity? Remember, the flexible budget does not show the actual results. The flexible budget uses the same formula assumptions, just with a different number of units. Again, like any accounting problem, it helps to see examples. This is the Barton company, Barton Robotics. It's in your textbook. And as you can see, this is on page 23-7 here as well. Let's look at the budget. Assume that you are the manager in charge of manufacturing overhead in the assembly department of Barton Robotics. In preparing the manufacturing overhead budget for 2022, you prepare the static budget as shown below, based on a production volume of 10,000 units of robotic controls. That is the estimated level of activity, and this static budget is going to answer the question, what do you think it's going to cost to produce 10,000 robotic controls? And these are the numbers they came up with. Budgeted costs for indirect materials, indirect labor, utilities, depreciation, property tax, and supervision. Now, some of those costs, as you well know, this is manufacturing overhead, and manufacturing overhead tends to be a mixed cost. What does that mean? It has both a variable and a fixed component to it. Now, based upon your knowledge and what you've learned so far this semester, you can probably figure out by looking at that list of budgeted costs which ones are variable and which ones are fixed. Indirect materials, variable. Indirect labor, variable. Utilities, variable. Depreciation, fixed. Property taxes and supervision, also fixed. So we go on to read. Fortunately for the company, the demand for robotic controls has increased, and Barton produces and sells 12,000 units during the year rather than 10,000. So remember, they built a budget, a static budget, a planning budget based upon the estimated level of activity, which was 10,000 units. However, in this example, they actually produced and sold 12,000 units. It goes on to say, you are related. Increased sales means increased profitability, which should mean a bonus or a raise for you and the employees in your company. Unfortunately, a comparison of assembly department actual and budgeted cost has put you on the spot. What we're looking at here is a performance report, a comparison between the budget and the actual. How did they do? The budgeted numbers here come from this budget report right there. The actual numbers are provided to you by the financial accountants, has to be given to you. They're the result of transactions, journal entries from financial accounting. So when we look at this, we look at indirect materials. The budget was $250,000. They actually spent $295,000, $45,000 unfavorable variance. They spent more than they should have spent. Indirect labor, the budget says $260, they actually spent $312. Again, unfavorable variance. Utilities, $190 versus $225. Again, $35,000 unfavorable variance. And there's no variance in depreciation, property taxes, and supervision. Now, one of the things that we mentioned earlier is some of those costs are variable, some of those costs are fixed. Let's remember variable cost. The total cost depends on what? The level of activity. And as activity goes up, so should the total variable cost. Well, isn't that what happened here? They had budgeted to produce 10,000 units, but they actually produced 12,000 units. 2,000 unit increase, 2,000 divided by 10,000 is 20%. So if the number of units produced went up, Shouldn't variable costs go up as well? So the static budget report doesn't really help us out. So what we need to do is to prepare a flexible budget. Let's go back to the definition of a flexible budget. The budget has been adjusted using the same formulas and budget assumptions, except that the actual, not the expected number of units sold. The budget has been adjusted or flexed to the actual level of activity, also known as the flexible budget. Answers the question, how should the company have performed at the actual level of activity? So that's what we want to know. We want to know what these costs should have been at the actual level of activity, at the actual 12,000 units produced. So we want to prepare a flexible budget. So the first thing we need to do, and you've done this several times, is calculate the variable cost per unit. Now, how do I do that? I take the total cost divided by the number of units. If I go back to that static budget report, I have total cost and I have number of units. So I can come up with the cost per unit for the variable cost. And that's what they did right here. The very first section, they took those variable costs, indirect materials, indirect labor, and utilities, and calculated the variable cost per unit. How? The budgeted cost divided by the number of units. In this case, they had $250,000 of indirect materials. They budgeted 10,000 units, $250,000 divided by 10,000 units, $25 per unit. Same thing with indirect materials. Indirect labor, $260,000 of cost divided by 10,000 units, $26 per unit. Utilities, $190,000 divided by 10,000 units, $19 per unit. So now you have the variable cost per unit. That's the cost formula that you can use to predict cost at what? Any level of activity. And that's what they did here. What would the cost be at the 12,000 unit level? Take the variable cost per unit they just calculated, multiply times 12,000 units. So you can see that for indirect materials, they got $25 per unit, 12,000 units, they got $300,000 of indirect materials at the 12,000 unit level. Indirect labor, they got $26 per unit, 12,000 units, $312,000. And then utilities, $19 per unit, 12,000 units, $228,000. We can now put together the flexible budget report. Let's look at these flexible budget numbers right here. Budgeted number of units, well, we're going to use the actual 12,000. Here's my indirect materials, indirect labor, and utilities, which I calculated right from here. Variable cost per unit times the 12,000 units, that's the cost. So now I can look at these numbers here. I can see what indirect materials should have been at the 12,000 units. Should have been 300,000. They actually spent 295,000, $5,000 favorable variance. They should have spent 300. They only spent 295. It's a savings. Indirect labor, they should have spent 312,000. They actually spent 312,000. No variance whatsoever. And then utilities, they should have spent $228,000 at the 12,000 unit level. They actually spent $225,000. Again, a favorable variance. They spent less than they should have spent. So what about these here? These are fixed costs. No need to calculate cost per unit because they're fixed. Remember the definition of a fixed cost. Total cost stays the same as volume changes. So in this example here, depreciation didn't change. Property taxes don't change. Supervision doesn't change. Whether it's 10,000 units or 12,000 units, fixed cost stays the same. And there's no variance between the actual and the budget. So rather than having what they thought was $132,000 unfavorable variance with this static budget report, when they look at how they should have performed at the actual level of activity, they have an $8,000 favorable variance. So looking pretty good. Let's take a look at a problem. So this is exercise 23-9 in your textbook. Let's read it. Let's look at the solution. As sales manager, Joe Batista was given the following static budget prepared in advance. For selling expenses in the clothing department of Soria Company for the month of October. So again, this is a static budget report. What does that mean? It means these budget numbers here were prepared at an estimated level of activity. The estimated level of activity was 8,000 units. The actual level of activity, 10,000 units. They sold 2,000 units more than they had estimated. Let's read on. As a result of this budget report, Joe was called into the president's office and congratulated on his fine sales performance. He was reprimanded, however, for allowing his costs to get out of control. Joe knew something was wrong with the performance report that he had just been given. However, he was not sure what to do and comes to you for advice. So he's looking at this budget report, which is a static budget report, which is a comparison between the estimated level of activity and the actual level of activity. So sure, he sold more units than he should have, but he's got these unfavorable variances. But aren't some of these expenses here variable costs? So numbered, so labeled. Variable expenses, sales commissions, advertising, travel, free samples given out. So if they're variable, shouldn't the total cost go up as the number of units goes up? The answer is yes. But how much? What are they asking you to do here? Instructions: prepare a budget report based on flexible budget data to help you. Should Joe have been reprimanded? So let's take a look at the solution. And what's important to understand is that this budget number here is now a budget based upon the actual level of activity. Not the 8,000 units, which was the estimated level of activity, but the actual level of activity, which was 10,000 units. First thing you got to do is figure out what's the variable cost per unit. They gave you those numbers here, but let's walk through it together. How do we get these numbers? We have to go back to the problem. And we say to ourselves, what is the variable cost per unit for sales commissions? Well, again, cost per unit, something we're very familiar with. The sales commission is $2,400. The number of units is $8,000. $2,400 divided by 8,000 units, 30 cents per unit. What about advertising expense? Advertising expense, the total is $720 based on 8,000 units. The variable cost per unit, 9 cents per unit. Travel expense, they came up with 45 cents. How did they get that? Again, travel expense was budgeted at $3,600. They estimated 8,000 units, 3,600 divided by 8,000, 45 cents a unit. And the same thing with free samples. They estimated a cost of $1,600 divided by 8,000 units, 20 cents a unit. So they have the variable cost per unit. Now they can project what the cost should be at the 10,000 unit level. 10,000 units, 30 cents a unit, $3,000. Advertising expense, 10,000 units, 9 cents a unit, $900. See the point? What about these fixed expenses? Remember, they don't change. These fixed costs here for rent, $1,500, sales commission, sales salaries, $1,200, $800, $500, fixed cost. Cost per unit stays the same as volume changes. So whether they produce 8,000 units or 10,000 units, they stay exactly the same. This column right here is now your flexible budget. We can now compare them to the actual numbers given to us by the accountants. And now we have a meaningful comparison. They should have spent $3,000 on sales commissions. They only spent $2,600. They spent less than they should have, $400 favorable variance. Advertising expense. They should have spent $900. They only spent $850, $50 favorable variance. Travel expense should have spent $4,500. They only spent $4,100, $400 favorable variance. You get the point. These are all favorable variances now. Let's look back. The static budget report had a $630 unfavorable variance. But when we prepare a flexible budget report, actually has a $1,450 favorable variance. The answer to B, no, Joe should not have been reprimanded. As shown in the flexible budget report, variable costs were $1,450 below budget. Savings, favorable. Now I went a step further and I gave you the cost formula to predict total cost, which is what? Variable plus fixed. The variable cost per unit, $1.04 per unit. Simply added up those four numbers, $1.04 per unit, plus what? The total fixed cost, $1,500, $1,200, $800, $500, $4,000. So it's a mixed cost. There's the cost formula, something you should be familiar with. $1.04 per unit plus $4,000 per month. So far, we've seen Barton Robotics. We saw a nice example here, Soria Company. I have added another problem here. This comes from a different textbook, so it says something about chapter 8, don't worry about it. It comes from another textbook. I've given you the problem, and I've given you the solution. Let's walk through it briefly. I think it's fairly easy to follow. Let's take a look at it. Auto Lavage is a Canadian company that owns and operates a large automatic car wash facility near Quebec. The following table provides data concerning the company's costs. So we're providing you with the cost formulas to predict expenses. Remember, some costs are variable, some costs are fixed, some costs are mixed. They have both components. Let's look at a couple of them. Cleaning expenses. Cost per car washed, purely variable, 70 cents per car. Electricity, mixed cost, $1,400 per month plus 10 cents per car. Maintenance, purely variable, 30 cents a car. Wages and salaries, again, a mixed cost, $4,700 per month plus 40 cents a car. Depreciation and rent are purely fixed, no variable component. Administrative expenses, again, is a mixed cost, $1,800 per month plus 5 cents a car. Those are the cost formulas. It goes on to say, The company expects to wash 8,000 cars. That's the estimated level of activity. And to collect an average of $5.90 per car. That's the revenue per car. So what are they going to ask you to do? Prepare the company's planning budget for October. Planning budget, what? A budget based upon the expected level of activity using those cost formulas. Here's the solution. The planning budget, I've highlighted in yellow for you. Budgeted cars washed. The expected level of activity, 8,000. The revenue, 8,000 cars times $5.90 a car, $47,200. Here are all of your expenses. If it's purely variable, 8,000 cars times 70 cents a car, $5,600. Here's a mixed cost. Electricity, $1,400 plus 10 cents a car. 8,000 times 10 cents is 800. 800 plus 1,400, $2,200. Here's an example of a fixed cost. There's the rent, $2,100 per month. Just drop in $2,100. That's the planning budget. Based upon their estimated level of activity, 8,000 cars, they expect to have net operating income of $16,500. Let's look at exercise 8. Refer to the data for auto lavage in exercise 8-7. The company actually washed 8,100 cars in October. That's the actual level of activity. 100 cars more than estimated. Prepare the company's flexible budget. So you're doing exactly the same thing as you did in the previous solution, except you're using 8,100 cars, the actual level of output, versus the estimated level of output of 8,000. Same process. Sales revenue, 8,100 cars times $5.90 a car, $47,790 of revenue. Cleaning expenses, again, 8,100 actual level of activity times 70 cents, $56.70. You know what else is really important? Fixed costs don't change. Fixed costs stay exactly the same. Why? Because the definition of a fixed cost, total cost stays the same as volume changes. So whether the company sells 8,000 cars, 8,100 cars, the rent stays the same at $2,100. Let's look at a mixed cost. A mixed cost, electricity, $1,400 plus 10 cents times $8,100. That's the flexible budget. A budget prepared using the actual level of activity. Let's look at the third part of this problem. The actual operating results for October appear below. So this is an income statement given to you by the accountant with the actual numbers, what they actually received in cash and what they actually paid out in expenses. Prepare a report showing revenue and spending variances. Here's the solution. This actual results right here, you're just going to copy those down from what they just gave you, right? For example, revenue is $49,300. Comes right from here, right? So you just copy these numbers down and put them in this column here. Actual results. This number right here, the flexible budget, you just calculated those. Those are these numbers right here. Budget based upon actual level of output. Now you have a meaningful report. You can compare how the company should have performed if they sold 8,100 cars, washed 8,100 cars versus what they actually did. How they should have performed, the flexible budget, in comparison to how they actually performed. Now we can look at it. Let's look at revenue. They should have earned $47,790 but they actually received $49,300, an increase, a favorable variance of 1510. Here, cleaning supplies, for example. They should have spent $5670. They actually spent $6,100, unfavorable variance. They spent more than they should have spent. Let's look at some of the fixed costs. Let's look at the rent. They should have spent $2,100. They actually spent $2,300. We don't know why. Maybe the landlord raised the rent for the month. Who knows? We don't know. But unfavorable. And then the last item here is the net income. They should have had net income, $16,935. They actually had net income, $17,430. Favorable variance. They earned more than they should. Well, there's a bunch of examples. You've got the Barton Robotics. You've got the Soriana Company, and you've got Auto Lavage. Please spend some time, understand these examples. Also, I have selected a bunch of practice problems on Wiley. These are multiple choice in nature. Please look at those examples. It'll be helpful. Good luck. See if I can now stop this. Stop sharing. And we will. Okay, thank you very much.